Hello everyone and welcome to chapter 2 basic financial statements. In this video I'm going to review the whole chapter for you. So as you all know that when we look at the basic financial statement, we are going to focus on the three financial statements, and those are important financial statements. So once you have a look in any financial statement, it will be divided into these three primary financial statements: balance sheet, income statement, and the statement of the cash flow. If you remember, when we talk about the balance sheet, we can refer them as a financial position. Sometimes they call income statement, sometimes they can call statement of income. And then the last one is a statement of cash flow or cash flow statement. So these are the basic three financial statements that we are going to cover in this chapter. If you remember, when we look at the balance sheet, we talk about asset that is equal to liability plus equity. When you look at the income statement, you talk about income, you talk about expenses, and you talk about the net profit. And when you look at the statement of cash flow, we divide them into operating cash flow, investing cash flow, and financing cash flow. So these are the basic structure or the components that you have to look at in each financial statement. So when you have a look in any financial statement, first of all, don't afraid of it. You have to look at the top of those paper. They usually come with the 3-line title. The first line gonna let you know about the company name. The second line will let you know about the name of the financial statement. For example, balance sheet, income statement, and the statement of the cash flow. And then the third line gonna let you know about the period covered by the report. If you remember, these two, they are like a video that record the whole transaction for the whole year. However, when you look at the balance sheet, they let you know about the financial position of the company at the specific date. When you look at the income statement, they let you know about the revenue minus all expenses. It's going to be the net profit, and they let you know for the period of time. For example, for the whole year 2021. So if you have a look here, like I discussed with you in class, revenue will provide a positive cash flow. Okay, so it means cash inflow, positive cash flow, or cash in. So any transaction that provide the revenue will provide you a positive cash flow, and you can see that we can divide into operating cash flow. In the opposite way, when you look at the expenses, it will bring the negative cash flow. Okay, so this is the relationship. So as I have already let you know, the income statement let you know about the revenue minus expenses is going to be net profit or simply net income. But if the company report loss, we will call them net loss. The third financial statement, like I have already mentioned to you, is the operating cash flow. It talks about the cash in and cash out based on your core business. It's based on your core product and service that you provide for the customers. The second cash flow is going to be investing cash flow. You invest in the fixed asset, you sell the asset, we will take into account of the investing cash flow. And finally, we talk about the financing cash flow. If you borrow money from the bank, if you repay the debt to the bank, if you pay the interest, those things are part of the financing cash flow. If the investor invests in the company, they put in additional equity, we put them as a financing cash flow. So both financial statement here, they represent the information happened in the period of time. However, when you look at the balance sheet, that's going to be the information of the specific date. So from now on, let's have a look on the structure of the financial position. So if you have a look at balance sheet or financial position, that represent the same thing. Here is the balance sheet or the financial position. They let you know about the asset situation of the company as well as the liability and equity. Okay, so in terms of the asset, it's going to begin with the current asset and move on to the fixed asset here. And in terms of the liability, note payable is mean the payable that you deal with the bank. Account payable is mean the payable that you need to deal with the employee, your supplier. And finally, salary payable is mean the money that you have to pay to your employee, but you haven't paid yet. Okay. One of the relationship that you need to see is that asset always equal to liability and equity. Okay. So this is the basic structure that we have to look at financial position. Then the concept of the business entity is mean that we have to separate the business money from owner money. Okay, this is a concept of the business and entity. Based on my observation, several company in our country, the company money is the owner money, so we have to separate them. Okay, so we have the clear performance of the company. When we look at the asset, basically we can refer them to the economic resources that you will use these economic resources to provide the revenue in the future. You can have a look at all of these. They are the resources. Focusing on receivable is mean the money that you have to receive, but you haven't received it yet. Okay, we can refer them to the receivable. And basically, those resources will will provide you the positive cash flow in the future. So basically, when we look at the asset, we will employ this four principle. It's based on the cost that you acquired, and it is move on with the going concern consumption assumption. Is mean that the company will continue their operation. And then objectivity principle is mean that we need to be unbiased and we need to take care of move on with all numbers on a fair basis and based on the accounting principle. They are part of the stable dollar consumption assumption. It means that we need to employ one currency in each financial statement, and we are expected that there will be in the stable currency. So these are some guiding principle underlying on the asset. When you look at the liability, it means the debt, some money that you owe to someone. So it will represent the negative cash flow in the future, like I told you. Okay, so these are example of the current liability or short-term loan. So when you look at the short term, it means one or less than 1 year, and when you look at the long term, it means more than 1 year. So account payable, it refers to the money that you have to pay to someone, but you haven't paid it yet. That is the meaning of the liability. Owner equity, it represents the part of the owner of the company. You can see that the whole company, they have 300,000 in terms of the asset, but they have 80,000 in terms of the liability. So the owner claim in this company refer to 220,000. So this is the owner equity or the owner part of the company. If the company have some problems, so they can claim on this portion. Share in owner equity, like I discussed with you that the company once the company grow up, the equity part grow up. Okay, so the equity part will grow up from a few reason. Okay, the investor or the equity inject the money in the capital stock or the company report profit, and then they retain some money in the company. So that gonna represent increase in terms of the equity. Okay, so if the owner investment put the money in the company and if the business they have earning, so equity will grow up. On the opposite way, equity will move down. So here is the basic accounting equation like I have already let you know. Asset, it is equal to liability plus equity. You can trace this equation in every financial statement. So if I hide the liability here, you know about this, so you must be able to calculate the liability. So from now on, like I told you in the first chapter, that basically accounting, we are going to do the accounting transaction. It means that we have to record all the transaction. So the following case study is some company called JJ Loan Care. We are going to see their transaction and how they are going to record those things in the financial statement. So let's have a look on this company. The name of the company is JJ Loan Care. All of the transaction begin on the 1st of May. The owner of the company invests $1,000 in the company. So if you have a look in this transaction, the owner invests $8,000 in the company. So it will increase the capital stock in the owner equity as well as once they put the cash in the company. So the cash increase 8,000. So from now on, what you have to be careful is that any transaction that you are going to move on here, both sides will always balance together. Okay. So once you have a look in this balance sheet, you will see that the transaction we are going to record them with the red font. Okay. So basically, the first transaction is that they put the cash in the company that's going to increase the capital stock as well as the cash increase. On May 2nd, the company purchased the equipment 2,500 in cash. So you can imagine that right now the company, they have 8,000 in terms of the cash, and then they invest in this thing 2,500. So finally have the cash will be 5,500, and then they are going to record some equipment. Okay. So have a look here. In the previous record, you can see that the cash is 8,000. Okay. And then right now, the cash decreased to 2,500 because they bring those money to buy the machine, the equipment, and then the equipment increased to 2,500. You can see that both sides must be equal together. On the following day, the company purchased $15,000 truck. However, in terms of the payment, they provide a down payment 2,000, and then they issue the note payable 13,000. So you can see that in this point, it increased in terms of the asset, it decreased cash, and increased in terms of the note payable. Okay, so this one is asset, this one is cash, and this one is a note payable. So as I have already discussed with you, have a look here. If you remember about the previous record, cash is 5,500, but they pay 2,000. So the cash decreased to 3,500. And then this is the asset. So the asset increased 15,000. And then the company, they have note payable 13,000. See? So once you read the case, you have to imagine that those numbers will represent some change in the balance sheet. Okay. So you can see that right now, instead of 8,000 in the previous record, they moved to 21,000. Okay. So any transaction that happened to the company, we have to record it properly. Move on. The company purchased some repair 300 on account. The word on account is mean that it will create account payable. Okay. So have a look here. So the tool and equipment, instead of 2,500, it increased to 2,800. It increased 300. And if you have a look on the right side of this balance sheet, it creates account payable 300. Okay. Every student here, keep in mind that if some number change in the left side, maybe that may be some change in the right side as well. Still, realized that she had purchased more than they need. She purchased 300, but she realized that she buy more than she needs. So she sell half of them 150, and then she will receive the cash within the next 30 days. So if you have a look here, it means the tool and equipment will reduce 150. And what happened here? It's gonna create account receivable. Okay, this is a good example of the account receivable. So they are going to receive this cash within 30 days. So let's have a look in the balance sheet. Right now, if you remember, this one reduce 150 and then it create account receivable 150. Both sides of the balance sheet, they are still equal to each other. On May 25, the company, the ABC is their customers. So their customer pay 75 as partial of the account receivable. So once you have a look here, what you are going to imply, cash increase, account receivable decrease. Okay, so cash increase 75 and account receivable instead of 150, it reduced to 75. See, so once you read any transaction, you must be able to imagine what will be the effect on the balance sheet. Move on. JJ pay 150 of its payable. What does it mean? It will reduce cash and will reduce account payable. It reduce cash, reduce account payable. So once there's something dealing with the cash, so some of the following issues they need to change as well. And remember, both sides they are still equal to each other. JJ record a loan cash service provided during the May. The client paid in cash, so they get the revenue from the customers. Okay, so once they get the revenue or the profit like this, cash increase and it's gonna increase retained earning in the company. So this is how we record those transactions in the balance sheet. The balance sheet is one of the most important financial statement. On May 31, JJ purchased gasoline for the lawn mower, the truck, 50 in cash. You see, cash decrease, retained earning decrease. You see, decrease, decrease. So this is how we record each transaction that happened in each day of the business. And then you can see what I have mentioned earlier is that when you look at the balance sheet, this is the statement or this is the financial position of the company on that particular day. So if you have a look in the May 31st, 31, you don't know about any day before that. Okay. So here is a summary. It means that they record in terms of the asset, liability, and equity, and then they record for each day. Okay, you can see the movement each day. You can see the movement each day. Here is what we call statement of cash flow. Okay, so once the company record all transaction, they will use that to generate the statement. So on the left side, it deal about cash. So all of the information, cash in, cash out, cash in, cash out. If you see the bracket here, it means the negative cash flow. If you see the number with other bracket, it means positive cash flow. Here is the income statement. Okay, they get revenue and then they pay some expense. So here is the revenue. So let's move on to the following discussion. Once you record all of the transactions, we are going to summarize them in terms of the financial statement. And the first one is the income statement. Revenue minus expenses going to be net income. Okay. And then here, once they record all of the cash flow, they divide them into the operating cash flow, investing cash flow, financing cash flow. So you can see that for the whole month, they provide positive operating cash flow, negative investing cash flow, and positive financing cash flow. You sum them all together, so it's gonna be increase in cash for that month. And since the company is set up for the first time, so the beginning balance is 0. So this is your cash balance by the end of the month. It means the cash that you have in the company. Okay, so here is the operating cash flow, here is the investing cash flow, and here is the financing cash flow, OIF, like I have mentioned to you, O, I, and F. So, as I have let you know, the balance sheet by the end of the month will be this line. Asset, if they ask about asset, it divided into 4 items. If they talk about the liability, it divided into items. And once they talk about the owner equity, they divide into 2 items. Okay. So you can have a look that if someone asks you about the balance sheet on May 11, it's going to be this information. So once they bring the information in the bottom line here, so it will generate the balance sheet like this. Okay. So based on the content that we discussed in this chapter, it means that once there are some transactions occur to the company, we have to record them properly. And once we record them properly, we can come up with the balance sheet for a specific date. Okay. So if you have a look here, this is going to be the summary of this chapter. From the beginning of the period until the end of the period, both financial statement here will be like a video. It record all of the revenue, it record all of the cash flow that happened throughout the period. But in terms of the balance sheet, they provide only a specific date in time. So here is some relationship that I would like to mention to you. If you see the balance sheet here, cash will link from the cash flow statement and the net income. If you retain all of them in the company, it's going to be here. It's going to be here. So here is some linkage between the 3 financial statements that we have discussed in this chapter. So financial statement and financial reporting, they are relatively important because they provide the information for both external purpose and internal purpose. We can use the financial statement to compare the performance among the company, your company and your competitor, as well as we can compare our company with the industry and the global comparable. Okay. One of the important thing is that there are 3 forms of the business. The first one is a sole proprietorship. What does it mean? It means the business with only one owner. Partnership, at least 2 owner, and corporation is mean more than 3. Each of them have pro and con. In terms of the sole proprietorship, it means very easy to set up. Partnership, at least 2. Corporation, at least 3 people set up the company together. So what I would like to share it to you is that in each type of the business, maybe they have a different, a little bit different ways on how we look at the balance sheet. If you look at the sole proprietorship, that's going to be just one owner in terms of the equity. So in terms of the partnership, they divide into the two owners. And in terms of the corporation, all of the money that the investor invests as equity in the company, we call them capital stock. And once they have profit, we retain them. We call retain earning. Okay,นะครับ. So basically, financial statement provide the information for internal and external purpose. However, for the external purpose, for example, the creditor, the one who gonna give you money, for example, the bank, they give you a loan, or the investor that gonna invest in the company, they focus on 2 things. The first one is the liquidity of the company. The ability for the company to pay their short-term loan, okay? We call them liquidity. For example, they have enough cash to move on with their business, and they also would like to know about the company performance or the profitability. So the external party is mean any party outside the company that they are interested to analyze your company. So they have basically 2 concerns. And basically these 2 concerns, they are going to analyze your financial statement. Once we discussed in class, if you remember, we talked about note to financial statement. And basically, if you know, financial statement provide you only number, but note to statement will provide you additional information. One thing I would like to conclude with you is that note to financial statement is part of the financial statement. So if you have a look on item cash, maybe you are interested to have a look about the detail of cash. So you can have a look to add note to financial statement. Okay. So creditor นะครับ or someone that provide you a loan, they are interested to see your financial performance. So if you have a good performance, if you have a strong financial position, so they can provide loan to your business. Okay. In terms of the window dressing, it means that the company try to do something to make the financial statement look stronger. Okay, that is like what we call window dressing. So the whole idea that we need to be covered in this chapter, and it's going to be very important, is that how you record those transactions in your balance sheet. Okay, so maybe you need to review this video point to point, and if you have any question, please let me know.